So a good portion of this chapter does deal with rental income and how it's handled. We report generally our income related to rental properties on Schedule E, and any expense that relate to generation of that income is also reported on Schedule E. There's an exception to this, and that is that if the taxpayer is in the business of renting real estate, that's what they do for a living, then it wouldn't be reported on Schedule E, it would be reported on Schedule C, like any business. So we've talked in the past about what ordinary expenses are, and they relate to customary and usual expenses that are designed to generate rental income. So example of the rental activities given is advertising, repairs, and maintenance. Management fees, depreciation. It's important to note that the order in which these expenses are listed is important, and we'll talk a little bit about that later. We've reviewed in the past that rental property that is used for residential purposes is depreciated on a straight line basis over 27 and a half years, and then non-residential real estate is amortized or depreciated over 39 years on a straight line basis. We've talked before about how to depreciate property. One thing that's interesting in the tax code relates to this third bullet point, and that is that if we buy, for example, a rental property that's fully furnished, normally furniture is depreciated for business purposes on a 7-year schedule. However, if the furniture is part of the rental property, there's an adjustment, and we actually depreciate that furniture over 5 years. So there's a 5-year rule for furniture when it relates to rentals. Otherwise, for regular business purposes, furniture is depreciated on a 7-year schedule. Some of the concepts, while this chapter isn't particularly long, some of the concepts are a little bit complex, and so feel free to replay the video, especially the demonstration problems, as needed, so that you can fully understand and assimilate the topics in Chapter 8. As I said earlier, if the taxpayer maturely participates in the rental property, if they're a real estate professional, then that's a regular business, so that would be on Schedule C. What we're talking about in this chapter are Schedule E rentals, where the rental of duplex, for example, or an apartment building is not part of the taxpayer's major income stream, but rather something they do on the side, and then, of course, then the income is at Schedule E. What constitutes rental income? It could be, of course, cash paid. It could be services provided by the tenant, property given to the landlord or to the owner by the tenant. That's all regarded as income. So the distinction then between the kind of rental property we have is very important. So if we have, for example, a vacation home, and the question is, how often do we rent that vacation home? Because that will help us to understand and determine how we would account for it on our tax return. So, for example, if it's primarily rental, then it's a Schedule E property, and we can take all the expenses related to the rental and reduce them and against the income, and even generate a loss. And how that loss is handled we'll be discussing both in this chapter and in the subsequent chapter. But if it's primarily rental, it can generate a loss. If it's primarily personal, and we have some tests that we use to help determine this, we'll be going through shortly, then any income generated by for example, the rental of a vacation home is not taxable, nor are the expenses deductible for Schedule E purposes. And then the more common example is that the vacation home may be used for both personal and rental purposes, in which case a loss may not be generated. So those three categories then are determined by some tests that we go through. And so let's take a look at a situation where we have a vacation home that's primarily a rental property. In this case, we have Jose owns a vacation home. He uses it over Christmas for 7 days, and he rents it to vacationers for 90. Well, that's primarily rental, because he uses it for vacation purposes, less than the 15 days, which we'll talk about shortly, or 10% of the 90 days. And so 10% of the 90 days is 9 days, and certainly 7 days is less than the 15. So this is a primarily rental property, and we would account for it differently on the Schedule E. Personal use property is a rental property, for example, a vacation home again, that is used, for example, by family or non-family free of charge. In the case of a family member, the use is considered personal even if that member pays fair market value. So there's a slight exception to family members, so even if they pay fair market, it's still considered for personal use. And any time spent working on the vacation home, such as doing repairs, is considered an expense for rental purposes and is not considered personal use. So here are some of the rules that help us understand if it's primarily rental, primarily personal, or if it's a combination of the two. So a rental property that is used no more than 14 days for personal purposes, or 10% of the total rental days, whichever is greater, is considered a primarily rental property. As I said earlier, the income and expenses are reported on Schedule E when it's not the taxpayer's primary business. And then any expenses that are like indirect expenses, such as property taxes, those would have to be allocated between personal use and rental use. Also, I mentioned that generally, or I alluded to, earlier, that losses for rental property, when it's primarily rental, can be taken. However, generally it's only up to the point of rental income. There is an exception, however, for lower income earners, and that is that if it's primarily used for rental, for example, and there's a loss on the rental property, that is, the expenses exceed the income, then there is an allowance for certain lower income taxpayers to offset $25,000 worth of these passive losses against active income, such as earned income. Otherwise, without this exception, any passive losses incurred on renting vacation homes can only be used to offset passive gains. And we'll discuss the passive activity loss rules more fully in Chapter 13. For our purposes in Chapter 8, we're going to focus on how to determine whether or not the property is primarily personal, primarily rental, or personal rental, and then how to account for it. So here's a case where we have Mandy rented her home in Laguna Beach, California for 190 days for $36,000, and she used it for 17 days. Well, this would be primarily rental, because remember the test. The test is that it's not used for personal purposes for more than 15 days, or 10% of the days it's rented. Well, 10% of the days it's rented is 19 days, 190 times 10%. So now we have to ask ourselves, was it used for personal purposes for 19 days? And in this case, it was not. It was only used for 17 days for personal purposes. That's below that 10% threshold. Therefore, this is a primarily rental property. If a home is rented for less than 15 days, but otherwise used for personal purposes, then we said earlier it's used for primarily personal purposes, and therefore, if you do rent it out, for example, let's say for 8 days during the year, and that's all, then you wouldn't have to report that income on your tax return, nor would you be able to deduct any expenses related to that income. So a property that's used primarily for personal purposes is one that is rented for less than 14 days. So here we have Maya rented her cabin in Big Bear for $2,000 for 10 days over the holidays, and she and her family use it for the rest of the year. Well, that falls below the 14-day threshold, and therefore, that is to say, it was rented less than 14 days. Therefore, it's considered primarily personal, and again, we wouldn't have to report the income on this short-term rental on our taxes. If a rental property is used more than 14 days for personal purposes, or 10% of the rental days, whichever is greater, as we said, and rented for 15 days or more, it is considered this combination of personal and rental property. And all income and expenses might have to be reported on Schedule E, and we, as I said earlier, would have to apportion certain shared expenses between rental purposes and personal purposes. Here's a case where Adriana rented her lake house for 90 days for $13,500, and she and her family used it for 50. So in this case, the 10% of the 90 days rental is 9 days. So that's above the 50 days is certainly for personal use is certainly above that 9 days. And then also it's used for personal purposes more than the 14 days, which we mentioned back here. Therefore, this property is categorized as personal rental. When it's categorized as primarily rental, that is, the rental property is used no more than 14 days for personal purposes, or again 10% of the rental days, whichever is greater, then this is primarily rental property. So in this case, there's an example listed in the text where Darren uses the property for 12 days. Again, because it states it in the problem in the text. The reason they're saying 18 minus 6 here is because 6 days were used for repairing the property. So if you, as we said earlier, if you repair the property, the vacation property, and you rent it out for part of the year, then those repairs, those days spent repairing are not considered personal. Therefore, the personal days in this case would be the total of 18 minus, used for personal, minus 6 days of those which are used to repair the property. We don't count those as personal use. Therefore, the personal use for Darren was only 12 days. And since 12 is less than the greater of 10% of rental days, or 14 days in this case, then this property is primarily rental. So even if you go up to your vacation home and the children play on the beach and they're using the home, but the taxpayer is busy repairing the home, then those days spent repairing do not count as personal use. So there are a couple of ways to allocate these shared expenses between personal and rental of property. That's either personal rental or primarily rental. One is the IRS method. And this IRS method applies, and I'll go through an example in a few minutes. This IRS method can apply to all expenses, and it's based on the number of days of rental compared to the total number of days used. And again, that'll be more easily understood with an example I'll run through. The other method to allocate at least interest and taxes is using the tax court method. And if you use the tax court method, you only use it to allocate interest and taxes, these shared expenses on the rental property. But you would do so not based on the number of days used for the year, but rather based on the rental use divided by 365. And then the remaining expenses are allocated using the IRS method. So let me go through an example of this to help hopefully make it more clear. So let me make this a little bit larger. All right, so I have two examples then. So in multiple choice number 27, we have a case where the percentage of personal use on the property is 68%. Therefore, the percentage of rental use would be 1 minus 68%, or 32%. So we have gross rental income of $9,500, interest and taxes of $6,000, and utilities and maintenance of $2,500, depreciation of $4,300. And the question is, how much of the depreciation, which is listed last intentionally, because it's subordinated to the other expenses, how much of this $4,300 can we deduct for rental purposes? By the way, these expenses are listed after allocation. So we don't need to allocate in this particular example between rental and personal use. They did that for us. All we need to determine is how much of this rental cost of $4,300 can we actually deduct. Well, when we have properties that's personal and rental, the total of our expenses cannot exceed the revenue. That is, the rental usage cannot create a loss. And since we must list depreciation last, in this case the question is how much of the 43 can we deduct? Well, I've set up a little algebraic expression here that'll help us to understand this, hopefully. And I'm letting x equal depreciation because that's what we're trying to determine. How much of this 4,300 can we deduct? So we have $9,500 in gross rental income, and we need to take out expenses, but only to the point where we wind up with zero income. Because as we said, since it's personal rental use, then we cannot create a loss. So we're able to take the full $6,000 in interest and taxes, the full $2,500 in utilities and maintenance. However, based on our algebraic expression, $9,500 minus the expenses of $6,000 minus $2,500 minus X, which is the depreciation, that expression is going to equal zero, or no loss or gain. So the income minus the expenses is going to equal zero. So that's my expression. Now I just solved then for X, which is depreciation. And so, really kind of a straightforward calculation. I just took the 9,500, and in a sense, I just kept deducting the expenses until I reached zero. Or another way to look at this is I took the 9,500 minus the 6,000 minus the 2,500, and I know that that's going to equal the amount I can expend for depreciation to get to, in order to get to zero. So 9,500 minus 6,000 minus 2,500 equals the amount I can expense of this 4,300 for depreciation. And so the answer is 1,000. So if I take our 9,500 minus 6,000 minus 2,500 minus 1,000 of this 4,300, I wind up with zero, or no loss or gain. And again, this applies to personal rental use property, that category of property. Because as I say, under that category we cannot create a loss, and depreciation is listed last. So that's the one we're going to have to sacrifice at least part of the expense if it turns out that we have more expenses in total than we have revenue generated. Excuse me. Another example is problem number 35 on the bottom of page 8-29. Here, well, we have to do the allocation. Above, the allocation was done, so we just needed to determine how much of the expenses we could deduct. Here we have to allocate between rental use and personal use. So they're telling us that we have 75 days of rental use. That is to say, we rented out the property for 75 days, and personal use was 22 days. So that's going to qualify as personal rental usage property. They give us the income at $15,000, real estate taxes at $2,000, utilities at $1,500, mortgage interest $3,800, depreciation is $7,200, and then $1,300 for repairs and maintenance. Now, in this case, they're telling us to use the tax court method. And what that means is that we're going to have to use, in order to allocate real estate taxes and mortgage interest, we're going to have to use the denominator of 365 days. So first thing I did is I reordered the expenses because the real estate and the mortgage is going to be allocated based on the number of days in a year. Utilities is next, repairs and maintenance, and then as I said earlier, depreciation has to come last, because if it creates a loss, then we're going to have to sacrifice some of the depreciation expense so that we don't create a loss. In this particular case, we won't have to worry about that because the amount of income will more than absorb all of the allocated expenses. So let's run through the calculations here. Okay, so we have to allocate between rental and personal use these shared expenses. And as I said earlier, we're going to take, using the tax court method, we're going to allocate these expenses based on the number of days of rental, which is 75, divided by 365. So in this case, we're going to take the 75 days divided by 365, and then we're going to multiply it by our real estate taxes of $2,000. So that's the tax court approach, using 365 as a denominator. By the way, had we used the IRS approach, and we wanted to allocate these real estate taxes of $2,000, that would have been different. Because here we would have still allocated the $2,000, but the denominator would have been, let me just run through this. The denominator would have been the total of 75 and 22, which would have been 97 days. So the calculation then using the IRS approach as opposed to the tax court approach would be the $2,000 of real estate taxes times the 75 days divided by the sum of 75 plus 22 total days used. So that would have been the expense had we used the IRS approach, but the problem calls for us to use the tax court method, which means that our denominator has to be 365, not 97 days. Okay, so that was just for comparison purposes, that was the IRS approach. And again, this tax court approach only applies to these two expenses, real estate and mortgage interest. So if I were to, just for comparison purposes, if I were to bring this down and again do the exact same approach for the mortgage, I would take the mortgage cost of $3,800. Let me get my equal sign in there. $3,800, and I'd multiply that times, again, this is the IRS approach, 75 divided by the quantity 75 plus 22. And that's the allocation of the 3,800 utility using the IRS approach. Now, the problem asks, as we said, for the tax court approach. So in this case, I'll just write here so we know that we're not using the IRS approach. It's just for comparative purposes. And now using the tax court approach for mortgage interest, here I'm going to take that same 3,800, but in this case I'm going to multiply it by 75 days divided by 365. And that'll give me a total allocation of mortgage interest of $780.82. So you can see that we don't get the big expense deduction on page 1, Schedule E, when we use this tax court approach. However, as you know, real estate and mortgage interest is, for personal purposes, a Schedule A deduction from AGI. So any of the amount of the $2,000 that we didn't use for Schedule E purposes, rental income property, any of that we did not use, we can go and deduct later on Schedule A. And that's the personal use, itemized deduction. But at least for Schedule E purposes, on page 1 of Form 1040, these are the two approaches for allocating real estate taxes and mortgage interest. IRS approach here versus tax court approach here. Now, what do we do with the rest of the expenses? Well, the rest of the expenses automatically use the IRS approach. So there is no choice for the rest of these expenses. We'll automatically use the IRS approach. And again, the IRS approach is exactly as I demonstrated up here to the right. And that is, we're going to take each of these expenses, in this case, utilities expense, and we'll multiply it by the fraction of 75 days of rental divided by the total 75 plus 22, or 97. And we will repeat that process for each of these expenses using the IRS approach. So here, as I'm going to slide this over to make it a little bit easier to see, we have no choice. We have to use the IRS approach. As I said up here, we're using the tax court approach, just for these two expenses. We are not allowed to use the tax court approach for any other expenses. Okay, so that's the way in which we allocate shared expenses when it's used for rental purposes and for personal purposes, that personal rental category, where we have to allocate shared expenses. Now, expenses, we don't have any in this problem, but what if we had expenses that directly related only to the rental property? And one that comes to mind for me, and I'm just going to insert this temporarily, one that comes to mind for me is advertising expense. Well, if we have advertising expense, there's no calculation needed. There's no allocation to be done. And so, let's say we had $500 of advertising expenses. We just enter the advertising expense on Schedule E. There's no allocation because this is not a shared expense. This is not shared between personal and rental purposes. So if I were to reorder this list, we could list this first. Because it's a direct expense. Again, this was just for comparative purposes. This is not part of the problem. But I just wanted to mention it because if it's a direct expense, there's no allocation needed, whether IRS approach or the tax court approach. Okay, so this is the solution then to problem number 35, using the tax court approach for real estate and mortgage interest, and then using the IRS approach for the rest. And by the way, is it possible to use the IRS approach for these 6 costs as well, like I demonstrated here? And the answer is yes, absolutely. So I could have used the IRS approach for all of these allocated expenses. But the problem asks us to use the tax court approach for the real estate and mortgage. And that requires a denominator of 365. So 75 into 365 times the expense. I hope that makes that a little bit more clear on how to allocate using the tax court method and the IRS method, and that's what they're discussing here. So I'm not going to go through another example. I don't think this is in the your PowerPoint slides, but again, it's just a way of allocating these shared costs between personal and rental using both the IRS method and the tax court method, which I just demonstrated. And so if you want to run through another example, these are listed in the PowerPoints. IRS method, pretty straightforward. You allocate all of your expenses based on the number of rental days divided by the total days used for personal and rental purposes. And you just use that ratio and multiply it by all your expenses. So here's an example where just the IRS method is used to allocate shared expenses between personal and rental use. And again, please remember that with personal and rental, we cannot create a loss. So if depreciation is listed last, then those costs have to be, we have to only take a fraction or a part of those costs if it begins to create a loss, as it says down here. Tax court method, again, this applies to the mortgage interest and property taxes only. So we have a rental income of $6,300. Mortgage interest now we're going to allocate using tax court method of the 4,300 times 84 into 365, 84 days of rental, divided by a total of 365 days in the year. Property taxes, same thing under tax court method, 84 into 365 times 2,300 gives 529. And then the rest of the costs we allocate using the IRS method. In this case, we have net income of $2,008, which is reported on Schedule E. As I said earlier, any interest and taxes that you don't use, in other words, you don't allocate for rental Schedule E purposes, they can be reported as a deductible expense on Schedule A like we always have done. Only the unused portion that was not used for rental purposes. Okay, so here we have another run through of these. An example where we have Jane and Richard. They own a vacation home during the year. They rent it for 75 and used it for personal use for 30 days. Okay, so you can see again, it's more 10% of 75 days is 7.5 days. So the 30 days is more than 7.5 days, and of course it's certainly more than the 15 days. So this would qualify as a personal rental property. So they're just listing the income and the expenses. So we need to know, are they going to use the IRS method, or are they going to use the tax court method to allocate mortgage interest and property taxes for rental purposes? So as it said here, the answer is it's for personal and rental purposes. It was rented for 15 days or more and used for personal use greater than the 14 days. So those are the tests we use. So here's an allocation then using the IRS method, where we just take the amount of the expenses. In this case, since we're using the same method for every expense, we can just take the total expenses and then multiply it by the 75 rental days divided by total number of days used, both rental and personal, of 105. So when you use the IRS method, you can just add up your total allocated expenses and then multiply by your fraction. You don't need to do it separately for each one. Well, yeah, the tax court method is different, and it applies, as we said, to property taxes only and mortgage interest. And so those expenses would be allocated based on 75 and 365. All right, so that's an overview of a good part of Chapter 8, which is the rental property issue. Another use of Schedule E is for royalty income. Now, not all royalty income is reported on Schedule E, but, for example, if you have royalty from your primary business, then that may be reported on Schedule C. But if you wrote a book on the side and maybe you work as an accountant or a manager or HR person, whatever it happens to be, but you wrote a book on the side, for example, then any royalties you receive on that book would be reported on Schedule E. What if, however, you went out and you promoted the book, signed autographs, went to bookstores? That would be different. That would be Schedule C income. Because that's not, while it's related to the royalty, it's actually not the writing of the book, and which is what you're being paid the royalty on. This is promoting the book. And so any income or expenses that you either receive or incur related to any income-producing activities would be reported on Schedule C. Another use for Schedule E is for the flow-through or pass-through entities. And we know, for example, that partnerships and limited liability companies, S-corps, these are flow-through entities, so they don't pay taxes. So if you have a partnership or a proprietorship or limited liability company, S-corp, they don't pay taxes, right? That income is passed down on 1040 to the principals or the owners, and then it's taxed there. But the entity, at the entity level for partnerships, LLCs, S-corps, for example, those entities are not taxed at the entity level. So we're going to pass down on what we call Schedule K1. We're going to pass down the various components of income and expenses and deductions to the owners, and then they will deduct that on their individual tax returns. And I'll go through an example of that briefly. And by the way, this is new for the 2018 tax year, and that is ordinary income from flow-through as well as Schedule C income may be eligible for the qualified business income deduction of 20%. We talked about that in Chapter 6 for lower income companies. So the first 20% of income is not taxable. So let's go through an example of this idea of pass-through entities. And the one I'm looking at is problem number 41, and that's in your text on the top of page 8-32. And all they're asking really for is, we're not going to go too deep into calculating the amounts on K1, but we do need to know where the information, what tax form that we should be using. So in problem 41 on page 832, Nicole and Muhammad are married taxpayers. They filed jointly. They're equal owners in an S corporation, so that's a pass-through. The S corp itself is not taxed. The company reported sales revenue of $450,000 and expenses of $310,000. The corporation also earned $20,000 in taxable interest and dividend income, and $15,000 of investment interest expense. Where are these amounts reported? Well, I did calculate the S corp operating income, which was just the $450 minus the $310, and so their operating income is $140. So this gets reported then on Schedule K1, and that is just a way to allocate this income to the various, in this case, owners, equity owners of the S corp, based on the number of shares they own. And so that amount, the 140, does get reported on Form 1040 of the stockholder on Schedule E, as we said earlier. It also had taxable interest and dividend income of $20,000. That gets reported on Form 1040 Schedule B. And then finally, the investment interest expense is reported on Form 1040 Schedule A, and that offsets investment income. Okay, so that's kind of a brief rundown of some of the tax forms we'd use for pass-throughs for income passing through to the owners. Just could have been the exact same allocation if we were talking about a partnership instead of an S corp. So as I said, just to kind of review a little bit, the flow-through entities, they do have to file informational returns. So for example, a partnership would file Form 1065, and then it would send K1s down to the owners, just to let them know, this is your share of the operating income. This is your share of any Section 179 expenses. This is your share of any capital gains and losses. This is your share of any contributions that the partnership or S corp made. And as I said, any income or loss is reported on K1, from K1, onto Schedule E of the owner's tax return. And I went through an example. I didn't talk about Schedule D, but capital gains and losses would be reported on Schedule D. So in our earlier example here, had we had any cap gains and losses, so I could insert here, for example, let's say we had a long-term capital gain by the S corp of 20,000. Let's make that 50,000. All right, so I had this was not part of the problem, of course, but I'm just changing the problem to make the point. In this case, then, we'd have S corporation capital gain, and then that would be reported on Form 1040, and that would be Schedule D for any long-term capital gain. Okay, so had the problem included that, we would have reported on Schedule D. And by the way, just to reiterate, any passive losses generally cannot offset that, any of those forms of income, with that exception of the $25,000 if it's a real estate-related passive loss. Then for certain lower income earners, You can take a passive loss if it involves real estate against portfolio and active income, but that's the exception. And we'll talk about more of that in a future chapter. And there again it mentions that $25,000 when it relates to rental activities. And we'll hit upon that more in Chapter 13. If you have any questions on Chapter 8 or any of the problems I went through, please let me know.